What's up, guys? Welcome to Stock Talk with Nico Kritikos. Today, we're going to be doing some stock analysis for Intel stock. And this is a stock I bought recently. As you can see here, I got 52 shares at an average cost of $30. And so I bought at a 5-year low, but it's still going down. So we will see what happens with that. But Intel, for a basic introduction, is the #1 United States chip making company. Their last earnings report was not too good. They are actually now guiding for minus $1.5 billion of free cash flow for this year. So Intel, in the past, they have been one of the dominant players in the space. So they are one of the only, I think they might be the only company that actually designs the chip and manufactures the chip. So other companies, the only manufacturers are Samsung, Taiwan Semiconductor, and then Intel. But the difference is that Intel designs the chip as well. So most other companies out there like Qualcomm, NVIDIA, AMD, Apple, those companies will design the chips and then these companies make them. That's the difference. But Intel has kind of fallen behind the last decade or so. They haven't been able to keep up with innovation, and the chips that some of the other companies are making, like TSM, they are just getting an advantage over Intel. So that's the only thing about this company. They still have a huge amount of market share. As you can see here, it says, so TSM has over half the market share and makes chips for Intel and Apple, NVIDIA, and more. However, TSM could face trouble if China attempts to take over Taiwan, which is an option that could happen in the future. The good news is that the recent U.S. CHIPS Act that was signed will largely benefit Intel with their new $20 billion U.S. facility they are building. The U.S. is on Intel's side in a large part because the U.S. is trying to stand up to China, and since Taiwan is over there in Asia and Samsung is over there in Asia, Intel is, a big player on the U.S. side. And one of the problems here is that only 12% of the chips are made in the United States now, when 30 years ago it was more than a third of the chips. So things have changed over the last couple decades or so. So first thing on our checklist we're going to look at here is the stock down or oversold? And as you can see here, yes, it definitely is, because it's at a 5-year low now. On the 1 year, we're down about 50%. So that's going to get a check. Next up, we have, is the company increasing revenue? And I put yes, because it's increased 12% in the past 4 years, which is nothing amazing, but still, for how big of a company they are, that's still pretty good. Next up, we have, is net income improving? I put no, because if we look here, we can see in 2018 and 2019, they were doing about $21 billion of net income. In the last 2 years, that number has now dropped down to about $19 billion. So that's a little bit of a problem. Part of that has been because they listed supply chain issues and also the competitors as the 2 reasons for that. But you can see here, 2020 it went down to 20.9, and 2021 we're down to 19.8. And in the most recent quarter, they actually reported a $500 million of a net loss, which is not good either. So that's going to get a no. Then we have, is the healthy? Do they have a healthy forward price to earnings? I put yes. They have a 9 forward PE and a 6 trailing PE, which is super good. It looks super cheap for that. And their average PE is about a 10. It's been anywhere from like a 7 all the way to a 25 over the past decade. So we're definitely on the lower end. And their EPS is expected to increase 15% in 2023. So things should, pick up a little bit next year. This year is not looking too good for them, but that one's going to get a check. Then, is the company innovative, or do they have a moat? This one could go either way, because they're definitely not innovative. That's been their biggest problem the last 20 years or so. But they do have a pretty good moat, I would say. I think for how big of a company they are, their scale, and then their market share in the CPU sector is 30%, which is pretty strong too. So although Intel's thing is they're not making super advanced chips like TSM is. TSM, I believe, is coming out with 3 nanometer chips, while Intel is still working on the 5 nanometer, and TSM has been doing the 5 nanometer for years now. So they are years behind, but I think that most of their chips they're making are chips for they're larger chips for companies that don't need as advanced chips. So like car companies or fridge companies, the companies that make those products don't need the super advanced chips, and that's where Intel comes into play. Next up is the industry growing? Yes, it's supposed to grow at about 12% a year, so that's good. I mean, the other thing too is, like, with this industry being so big, even if Intel doesn't have the most advanced chips, I believe they still are going to play a part in that space, even if they don't have the most advanced chips. Is their return on capital improving? Yes, it's 14%, which is good, but it should be better really, because their 10-year average is about 17%. So I would like to see it be at least 17%. How are their margins? I put no, they're not good, because as you can see here in their PowerPoint, so gross margin for this past quarter was 44.8%, which was down year over year and below their outlook, which was not good. And then here you can see by each each part of their business, the client computing group, here is last year's operating margin compared to this year, or this quarter's margin. So last year, 39% operating margin, this year 14%. Then in the next part of their business, 38 all the way down to 5%. So it's been getting bad in all parts of their business. So that's going to get a no. Then healthy cash flow, I put no, not exactly, because if we look here, we can see that 2018 and 2019, things were looking good. Free cash flow was improving, operating cash flow was improving, but then 2020 and on, it's been kind of a disaster. The operating cash flow has gone down, their free cash flow has gone down. I understand they're investing a lot of money into things like building out these new facilities, but that's not really a good excuse for, you know, having a less efficient business. Like they still need to be making money and growing their profitability. So operating cash flow has gone from 29, 33, 35, 29, now down to 22. So we're at a 5-year low now for operating cash flow. And cash position is relatively the same. And as you can see here, they're investing a lot. 2021, they invested $25 billion, and free cash flow was negative for this past year. So that's not good. Diverse revenue streams. This could go either way too. I mean, I would say yes, because just because of how many customers they have and how many chips they're selling. I mean, they're doing, you know, what, over $70 billion of revenue per year. So that's pretty good. And they have so many customers. You know, even if they lose one, or even if they lose one small part of their business, I think they're still big enough to where they'll be able to sustain it themselves. So, I mean, one of the problems is, since they're only making a certain type of chip, that's not the best. But the other thing that's good for this is that they are designing the chips and they're also manufacturing them, like I said. So that is also something that is going to give them a little bit of an edge. Number 11, do they have more assets and liabilities or positive equity? Yes, they do. I believe it's about $100 billion of equity, so that's phenomenal. And then that brings us to number 12, is the equity over 10% of the market cap? Absolutely, $100 billion of equity. Meanwhile, the stock is what? Let's see. The stock is 113 billion. So it's almost 100%, to be honest. That's how you know it's undervalued. They have about 100 billion in equity, and that's almost what the market cap is now. Strong share buyback program. Yes, I would say it's good enough. The share count is flat year over year at 0%. So that's not phenomenal, but it's not bad. That's like acceptable. They have $7 billion left of their share buyback program left to go. So that should be some positive pressure on the stock. And then number 14, are insiders interested? No. At first I thought they were, because when I checked here, the normal website I use called tipranks.com, it's not working right now. So I found this, and although it says there's been some purchasing activity in the last couple months, when you look at the ratio, the insiders have been selling 3 times as many shares as they've been buying over the last 3 months and the last 12 months. As you can see here, 3 months, 14,000 shares bought. Meanwhile, they sold 40,000. Over the past year, 150,000 bought, 250,000 sold. So that's not a good sign. I mean, it's not always the best indicator of whether or not you should buy the stock, because insiders always make mistakes and don't buy or sell at the right times anyways, but it still says something. Number 15 is how's the management team and the executives? I put no. They've done a kind of a bad job, you know, keeping up with market share and innovating at the company. So that's going to get a no. Number 16, do they have more cash than what they do in average earnings or average income. So yes, they have 27 billion in cash, which is a ton of money, and they normally do about 21 billion in income. So that's great. Even if they have a bad year like this year, they got the cash to take care of it for the most part. They also are investing so much. They spent $25 billion investing last year that they're kind of using up a bunch of their cash, but it is what it is. Number 17, how is their dividend? Yes, it's healthy. It's 5% with a 30% payout ratio, 5% growth. So they are growing it a little bit, not a ton, but a 5% is a very solid dividend, and 30% payout ratio is super healthy. That means they could double it if they really needed to. And then number 18, this is a new one I added, is the company over 20 years old. I think this just says something about their longevity and their strength as a company. I think it's when you have newer companies that are 5 or 10 years old, you're taking more of a risk because it's not a proven and tried business model. So this one's different. This is a company that's been around for a long time, so that's going to get a check. All in all, we have a score of 13 out of 18. So this is going to get the pass to be a stock to buy. So thank you for watching. I will see you in the next video.